So, Tony, you expected a summer rally. We've certainly gotten that. What are we, 6% off the lows right now? What happens next?
That's exactly right, Sarah. Thanks for having me. So what we found a great indicator that can qualify whether it's a bottom or the bottom. And then if you figured out it's a bottom, how much should it rally before you retest the low? And what we found is that we should expect about another 5 to 10% from current levels before we reach kind of the bounce peak and then go back lower.
So what is the model? What goes into that?
So it's pretty, like everything I do is pretty simple because I don't understand the complicated stuff. It's a 10-week rate of change on the S&P 500. It's very simple. Anybody can make it. You just do a 10-week rate of change. When it hits minus 15, in other words, the S&P goes down 15% over the course of 10 weeks. Believe it or not, Sarah, it's really pretty rare. It's only happened 16 times since it's been a 500 stock index since 1957. So it goes down 15% and then pivots back up to minus 10% or better. So you hit an extreme and you start to bounce. And when that's happened in the past, there's only one occurrence I can find where it just whoosh, just kept going down, and that was early 1974.
So you see a few more percentage points higher from here, and then what? And then back south?
It's interesting, Sarah. 37% of the time, 6 out of the 16 times, we found that the market never retested. So I went back and looked to see if there was anything consistent about that. And of course there was. It was the Fed, what we've talked about before, a major signaling change from the Fed. In other words, you know how people refer back to 1970, which is the only time the first 6 months of the year were worse than now? Well, the Fed had already started easing in September, October of 1969. That's why you get that second half recovery. So the consistency is you don't retest, and I made this mistake in 2020. You don't retest when the Fed is fully backing and easing already.
But we're expecting a lot more rate hikes, right? And we haven't seen any signs really from the core of the Fed that they are pivoting, even if the market is starting to move on.
Sarah, it's interesting. As you know, there's two ways that rates move up. You have market-driven rates, and in this cycle, what has been a little bit different is the Fed told us where they thought the terminal rate was very quickly. So guess what the 2 to 10-year did? It went right there. So you already got the affordability index in housing having come down really hard. So that's tight. That's already shutting down the housing and real estate market. But then there's also the variable rate debt that's tied to LIBOR, which is, of course, tied to Fed funds, or SOFR if you want to use the new one. So every time the Fed moved, we've already we've already reflected the Fed's aggressiveness. But we haven't on that variable rate debt. And that's where there's two kind of legs that can hurt you in rate hikes. It's the market-driven rates and then the variable rate driven by the Fed. And as you said, Sarah, that has yet to see its peak. We're going to go up another 75 basis points in a couple of weeks.
So how would you be positioned right now as far as sectors and what leads this market higher in the near term and what you hang on to in the longer term, given some of the carnage we've seen?
Well, and as you know, when we started calling for this, we thought that the growth stocks would outperform. Basically, it's anything that is so extremely oversold and levered that got hit so hard in the first 6 months. That's what's going to bounce the most, right? And it's going to be at this. Now is not the time, and we've said this, for the last month and change. Now's not the time to chase energy when the demand side of the equation or materials or those areas that are deeply cyclical. It's very. I always said it with this. It's not good when you're spiking rates to a historic degree into a generationally levered system with increasing inventories and weaker demand. That's why it's so important to really get the bottom. You need that change in the Fed that allows investors to look through that statement and know that the other side has some legs.